Did you know that Warren Buffett's right-hand man, Charlie Munger, once turned a mere $1,000 investment into a multi-million-dollar fortune? It's true, and well, a chunk of that success came from smart, long-term stock picks. He has this art of choosing stocks that pay dividends and have the potential to grow and thrive for years, even decades. They are carefully selected based on their track record, financial health, and potential for future growth. Think of these stocks as the golden geese of your investment portfolio, laying yearly dividends. But can they truly withstand the test of time and market fluctuations? Stay tuned as we delve into each of these stocks and why Charlie Munger himself might give them a nod of approval. Number 8. POSCO Holdings Incorporated. First, let's dive into the world of POSCO Holdings Incorporated, South Korea's largest steel producer and a giant in the global steel industry. POSCO isn't just about producing steel. They operate 2 state-of-the-art integrated steel facilities, focusing on flat and stainless steel. Their diverse applications range from automobiles to ships, home appliances, and heavy machinery, showcasing their versatility and strategic prowess. Interestingly, POSCO holds a 40% share in the South Korean market and is a significant global player, exporting nearly half of its production, mainly to other Asian countries. But their expertise doesn't end with steel. They've smartly diversified, generating a notable portion of their revenue from non-steel sectors. And well, they stand out with their generous payouts for dividend enthusiasts, offering $1.89 per share annually. And the best part? These dividends come quarterly, ensuring a steady flow of income. Financially, POSCO's shares are currently priced at $89, but the future looks promising. Number 7. Ares Capital Corporation. If you seek an investment with strong returns, look no further than Ares Capital Corporation. Boasting a notable 9.8% dividend yield and a history of consistent dividend growth for over 13 years, it's a standout choice for income-focused investors. Their secret? Specializing in loans to mid-size U.S. businesses, mainly thriving when interest rates are high. Despite the ups and downs of the market, as highlighted by Charlie Munger, Ares Capital's focus on middle-market companies and its status as a business development corporation makes it a reliable source of high passive income, obligated to distribute 90% of its income to shareholders. For those seeking a blend of high yield and stability, Ares Capital offers a compelling investment option. Number 6. Jefferies Financial Group Incorporated. Picture the stock market as a thrilling ride of highs and lows, and in the midst of it all is Jefferies Financial Group Incorporated, a standout in the financial sector. They are more than just participants in the financial world. They're leading it with a broad range of services, including investment banking, equities, and wealth management. Jefferies shines regarding dividends, offering a solid 3.72% yield, well supported by their robust earnings. But their financial prowess doesn't end there. They've achieved an impressive 25% annual growth in earnings over the past 5 years. For investors who value consistent dividend growth, Jefferies has a remarkable track record, increasing dividends by an average of 17% annually over the last decade. Their per-share earnings are also on a significant upward trend. Undeniably, it's a beacon for growth and substantial dividends, offering a prime opportunity for investors seeking both security and potential for lucrative returns. At number 5, Ally Financial Incorporated.
Something that's intrinsically a very good business, meaning that an idiot could run it and it would do all right. And then we want that business, which an idiot could run successfully, to have a wonderful person in it running it.
There is a powerhouse in auto finance and insurance, and a shining star in digital banking. It's a digital-first juggernaut offering a suite of services that's as diverse as impressive. From mortgage lending to personal lending at the point of sale, Ally doesn't just tick the boxes, it creates new ones. But Ally's expertise doesn't stop there. They're also in the game of consumer credit cards, catering to the needs of equity sponsors and mid-market companies with a robust corporate finance arm. And for those looking for savvy investment advice or brokerage services, Ally has you covered. Interestingly, Berkshire Hathaway, the one led by the legendary Warren Buffett, owns a 9.9% slice of Ally Financial, valued at a cool $775 million. And let me tell you, this company stands firm in a banking world shaken by the Silicon Valley Bank's collapse, seemingly immune to the panic that grips smaller banks. Their strategy? It's all about consumer deposits. In a time when trust is currency, Ally attracted a wave of new depositors in the first quarter. And for those with an eye on dividends, Ally is a beacon of generosity, offering an average dividend yield of 5%. That's top tier, placing them in the upper echelon of U.S.-listed dividend payers. But the real showstopper is their dividend growth rate, an astonishing 24.6% compound average over the past 5 years. Number 5, VIAT Incorporated. Rethink the role of generic drug companies in your investment portfolio with VIAT Incorporated, a company that's breaking the mold. They are a powerhouse with a notable 5.16% dividend yield. Investing $100 in VIAT, that translates into $5.16 of annual dividends, a solid cash flow for any investor. And with a payout ratio of 31.21%, VIAT shows its financial strength, expertly balancing investor rewards with strategic growth investments. But there's more to VIAT than just dividends. They're behind well-known drugs like Lipitor, Viagra, and EpiPens, medications that have been in high demand for years, ensuring both stability and long-term growth potential. And here's where it gets even more interesting. VIAT is not just keeping up with their dividend payments. They're actively planning to increase them and pursue strategies like share buybacks to boost stock prices. This approach makes VIAT a standout choice for investors seeking a combination of steady income and potential for growth. Number 3, Costco Wholesale Corporation.
If I were investing money for some sovereign wealth fund or some pension fund, 30, 40, 50-year time horizon, I would buy Costco at the current price. I think it's that strong an enterprise and that admirable a place.
Costco transcends its role as a retail giant, captivating dinner table conversations for its business prowess and the unique shopping experiences and products its members cherish. In 2022, they shattered records with $227 billion in sales, marking a 17% increase from the previous year. With a robust membership base of over 125 million, an increase of 7.8% from the prior year, Costco has clearly struck a chord with consumers. The membership fees are crucial to their profitability, accounting for 72% of their 2022 profits. Consistently rewarding its shareholders, Costco began paying dividends in 2004 and hasn't looked back since. As of October 2023, they offer a dividend yield rate of 0.69% with a payout of $3.84 in US dollars per share over the past year. Notably, Costco has a history of increasing dividends for 19 consecutive years, with an average annual growth of 12.38% over the past decade. But Costco's appeal isn't limited to dividends. Their resilience during challenges, such as the pandemic, and their ability to balance affordability and quality keep shoppers loyal. Their unique membership-based model encourages repeated visits and has driven exceptional financial performance, setting Costco apart in the competitive retail landscape. Number 2, Citigroup. This is a juggernaut in the banking sector, equipped with an extensive workforce and branches nationwide. But here's where Citigroup really stands out. Unlike many banks that focus on traditional services like savings accounts, Citigroup excels in providing top-notch assistance to businesses and accurately managing investments. They have been delivering returns to their shareholders for over a decade, a track record any investor would admire. While we can't predict the future based on past dividends, Citigroup's robust 32% payout ratio strongly indicates it is well positioned to continue its dividend distributions. Because when it comes to dividends, Citigroup doesn't hold back. They offer a compelling annual dividend yield of 5.42%, a figure that's sure to keep investors happy. And the future looks even brighter. The company is on track for a significant 12.6% profit increase in the next 3 years, and analysts anticipate that they will distribute approximately 35% of their earnings as dividends. The cherry on top? Citigroup's profits have been on an upward trajectory, growing by an impressive 17% annually over the past 5 years. This, combined with their measured approach to dividend payouts, indicates a promising path of continuous dividend growth. And at number 1, Kroger Company.
Value investing, the way I regard it, will never go out of style, because value investing, the way I conceive it, is always wanting to get more value than you pay for when you buy a stock.
Who could resist a great deal, especially in the stock market? Kroger stands out in the stock market as a true gem of value investing, known for its widespread supermarkets and multi-department stores in the U.S. More than just a grocery chain, Kroger has built a reputation as a robust institution. This year, they've seen a promising 3.14% increase in stock value. When it comes to dividends, Kroger offers a competitive 2.26% yield, surpassing the industry average, and has raised their annual dividend to $1.04 per share, a 10.6% hike from last year. Kroger's financial strategy is impressive, using only about 25% of its earnings for dividends, signaling fiscal solid health and potential for growth. Even in a competitive market, Kroger's financials are solid, with prospects for high dividend growth, debt reduction, and possible stock buybacks. The company's expansion into online sales and its partnership with Ocado further enhance its growth prospects, making Kroger a strong pick for investors in the dynamic retail sector. It's now clear that investing isn't just about the thrill of the chase, but the strategy of holding on to the right assets. So, which of these 8 stocks resonated most with you and why? And could it be the secret star of your next big investment decision? Drop your thoughts in the comments below, and let's keep the conversation going.
Running it.